Welcome back to the YouTube traders. This marks the start of a lot of new YouTube content coming this year in 2024. I'm going to keep all the content, raw filmed, not going to do any stupid crazy edits. That's not my kind of thing. Just going to be raw trading content. If you have topics you want me to cover, let me know in comments or DM me on Instagram, anything like that. And I will get around to those sorts of topics because, as I said, loads of topics are coming. But this video, I want to jump straight into it. Is going to be about optimizing your risk management or risk management strategies for passing funding challenges because funding challenges are a great way to get more capital. The industry is huge now, growing all the time, even if there are some hiccups in it at the moment. But again, I'll talk about even things like this a bit later on in other videos. But I want to get straight into this one for risk management strategies for passing funding challenges. So it's 3 steps. Step number one, the first thing you need before even deciding your risk management strategy is you need to know what your technical strategy, so your trading strategy, can do and what it provides. So what I mean by that is you need to know, you know, exactly, for example, for the last year, what your trading strategy returns, win rates, loss rates is actually incredibly important for this, overall returns on average per month, all of this sort of important data. And the best way to do that is to manually go back and record that data. It's going to help a lot if you trade a mechanical process, or at least mostly mechanical process, because that means that the data you collect is going to be reliable. Because as I'm sure you've seen from a lot of people saying online anyway, if you trade a discretionary way, when you go back and, back test to record data, the data is not particularly reliable because when you have discretion, your discretion can change daily compared to if you are mechanical, those mechanical rules are going to be the same whether or not you look at them yesterday or you look at them tomorrow. That your view is going to be the same because the rules are what keep you on that same path. So this is step one. You do need to have those stats. And the reason for that is moving forward into step two and three, having stats on your strategy and knowing exactly how your strategy performs is going to be vital in how you do carry out steps two and three. So I mentioned briefly a moment ago that loss rates are important, and I want to focus on that now because they are very important. And the reason for that is because, with funding challenges, you have maximum drawdowns, you have maximum daily drawdowns as well. And the loss streaks that you may incur, which are going to happen to all traders, right, are going to depend heavily on what your loss rates are. So, for example, if you have a strategy where the loss rate is, say, 30%, you are far less likely to have long loss streaks than a trader who has a loss rate of 60%. Now, that's not to say one trader makes more money than the other, because that's completely untrue. You could lose 90% of your trades and still make money if you trade a big enough risk reward. Again, that's a topic for another video, but it's the truth. So whether or not you have a long loss streak isn't going to affect whether or not you can make money long term, but it is going to affect how you should approach funding challenges. Because if you trade a strategy that is prone to longer loss streaks, you're going to want to have lower risk because you don't want to fail that challenge, or at least you don't want to blow that up and then blow the funded account as well. So moving on to step two, is you need to choose the correct challenge itself. And that is going to be based on what you've done in step one, where you've got the stats. So what I mean by this as well, lots of challenges have different parameters. So we have, minimum trading days, maximum trading days for some. This kind of industry standard is 30 days for phase one, 60 days for phase two, although there are now a lot of no time limit challenges as well, which is going to be important with this. You also need to know with challenges, they have maximum drawdown rules. Kind of industry standard is -10 or -8%. And then maximum daily drawdown rules, which is, -8 or say -8, sorry, that's on total. Maybe -5 is more of the industry standard. And then you're also going to want to need to know, of course, the actual profit target, which industry standard now is about 8% for phase one and 5% for phase two. Now, the reason you need to have step one completed and have your stats for your strategy already is because they are going to impact whether or not you are even likely to pass a phase of a challenge. So if your strategy, for example, has a fairly high loss rate, meaning that you could have longer loss streaks, you are going to want to ideally choose a challenge where the maximum drawdown is a bit bigger. You're not going to want to choose a challenge where the maximum drawdown is 6 or 8% if you know your strategy regularly has 8% drawdowns. You're going to want to choose the ones that have 10% drawdown. Also, if your strategy doesn't regularly make over 5% a month or doesn't regularly make the 8% a month, then you're going to want to go for a no time limit challenge because it's unlikely you're going to pass a phase of the challenge within a time limit. Right, so it's just making these logical steps based on data, not opinion, because opinion means absolutely nothing as a trader. You want to make and take these logical steps based on data in order to make the challenge actually easier for yourself when you do get into the stage of doing the challenge. Because, trading under a funding challenge is more of a pressurized environment anyway. It's different to normal trading where you can just let an edge play out over many months. This you have set goals, set parameters, which does make things more difficult. So making it easier for yourself by choosing the best challenge for you based on what your statistics show your strategy can actually achieve is going to be vital. So make sure you are doing that by carrying out steps 1 and step 2. So moving on to step 3, and I'm going to talk about my risk management profile or slash strategy when approaching funding challenges based on the fact that I've carried out steps 1 and 2 whenever I get to this point. So how I approach funding challenges is I risk 2% on phase 1 and I risk 1% on phase 2. Now, there are specific reasons for that, which I'll get into now. So my strategy, the AER strategy, has about a 35% loss rate, meaning that long loss streaks are rare and also, a very long loss streak is very unlikely, meaning that, through the data I've got over the last 2 years, especially, we can see that a 5% drawdown or a 5 loss streak is possible. It has happened in that 2 years. It's just rare. And as a result, it means that if I do risk 2% per trade when I'm approaching phase 1, it's very unlikely I'm going to hit the -10 drawdown for most challenges. It is possible, like I said, everything is possible in trading, but it doesn't mean it's likely, meaning that that's what I base my decision off of, the fact that it's very unlikely. So by using 2% risk per trade on phase 1, I still have a very low risk of failing it, but I actually have a higher chance of passing it quickly because of the risk reward that I use with 3 or 5 hour targets, meaning that, with 2% risk per trade, it's likely that it increases the likelihood I will pass quicker without really detrimenting my risk too much. As I said, it's possible that I could fail 1 or 2 challenges in a year. That doesn't bother me, right? It's 1 or 2 challenges in the grand scheme of the whole thing. But it also means I can speed up that phase 1 if needed. Also with phase 1, I'm happy to have that slightly higher risk because, phase 1, you haven't really got anything at risk at this point. You've put in a small bit of time and a small bit of money to get the challenge. That's it. Whereas with phase 2, the reason I risk 1% is because I've already invested a good bit of time and some trades into passing the phase 1. Meaning as a result, with phase 2, especially with the smaller target, which is usually what, 5%, sometimes 4% with phase 2 of challenges, that has still a high chance or very high chance of being passed on 1% risk still, and a very, very low chance of being failed with that 1% risk. Again, with the 35% loss rate, it's still possible that I could get a -10 drawdown. It's possible with anything realistically because the market can change. It's just very unlikely. So as a result, 1% risk is very good for me in that case with phase 2s. But the key thing is, as I said, the difference between phase 1 and phase 2, the reason that I have different risk percentages on for each of these phases is because of the time investment I've done to get to that point. Phase 2, you're much nearer funding. You've already completed the longer phase 1. Therefore, I would like to minimize even further my chance of failing that phase 2 and maximize the chance of passing it, meaning that, I will drop the risk to 1% for phase 2 and 2% for phase 1. Now, just because that's what I do doesn't mean that should be what you do. As I said, carry out steps 1 and 2 in order to know exactly what your strategy can do. That's going to give you a huge amount of info and important information in terms of what your strategy can provide and whether or not you should be risking X amount per trade. And also, of course, step 2, choose the right funding challenge before setting up your risk parameters. But I don't do anything fancy. All I do is follow the rules in terms of my AER strategy rules at all times. And then I follow this risk management strategy for each phase. That's all I do. And then when you're on funded accounts, if you want to be safe, you can risk less than 1%. Again, it will depend on your strategy. But for me, I risk 1% usually on funding. The more funding I get, I'll probably drop risk a little more to say 0.7, maybe something like that. But as I said, it's highly unlikely I'm going to get a -10 streak anyway. It hasn't happened in the last 2 years. So again, very unlikely, all based on data. But that's why on the funded stage, I currently risk 1%. But as I said, when I get more and more funding, it's likely I'll drop that to around 0.7, something like that, just because the more you get, the more time you've invested into getting that funding and you want to be safer. But to actually pass challenges, which is the key for this video, just to summarize, step one, know what your strategy can do, put in the time to gather the stats so that you know loss rates, most importantly, win rates, returns as well, and the average return per month. Step two, choose the right challenge in accordance to what you found in step one. And then step three, make clear and specific risk management rules to follow in accordance to what you've done on step one and step two as well. So that's it. I'll keep it nice and simple. I don't need to add anything else in because that is all there is to it. Make sure you let me know in the comments if there's anything else that you want me to do. I'm going to be uploading a lot more YouTube videos. As I say, there's going to be loads coming this year. They're already all planned out. So subscribe if you fancy listening to them. You can always unsubscribe if you decide you don't like me later. So yeah, thank you. I'll catch you in the next video.